Hey everybody, this is Jim at SP500chart.com. It's about 4:30 here on the East Coast. We're going to take a look at the S&P 500 chart for what it's worth today. And nothing really changed, but we're going to do it anyway. And maybe we'll get some fresh looks at a few things. Before we get into it, I need to remind you that the website and the video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research, and you should be making investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional, just a guy that draws lines on charts. Let me tell you a real quick story. Years ago, there was a comedian. He was kind of an overweight guy. I think his name was Louis Anderson. That may not be the right name, but he told a story about when he was a kid. He had a parakeet, and the parakeet died. And his dad took the parakeet, and they tried to do a bathroom burial. And they took the dead bird and put him in the toilet and flushed. And Louis, the way he told the story was very funny. He says because no matter how hard they flushed, the parakeet wouldn't go down, so it just would spin in the bowl, round and round. Well, that kind of feels that this is what we're experiencing here with the S&P. This market just doesn't want to go down. It wants to just melt up. And you can see, as we take a look at this 3-day chart, you can see just, even though the S&P seems extremely tenacious at this point, I want to show you that this move that we're looking at is really quite tiny in the big picture. So you can also see that all of this action is starting to look a little wedge-ish, which means we could very well be coming close to the end of this nice, long, almost 4-year-long bull run. Now, if we do, I'm not prepared yet to say that we're going to, encounter the same kind of weakness that we had back in 2007 and 2008 that climaxed in early 2009. But what I am saying is this has been a great run, and since we are seeing, for example, this is kind of our average top line, and I did something a little different here. I extended it starting with the first high back in early 2010, and then the last two highs, which would have been both in 2012. Now you can see that this line does not line up with the highs of early 2000, well, not early, but the highs of 2011. It's also interesting that we can look at some major lows, with the exception of those that have happened in 2011, they all line up. So it appears to me as if maybe this was a little out of bounds, if you will, in 2011, creating a little bit more selling pressure that when we did come down, we came down quite hard and violated this bottom line. But other than that, other than this period of, which is a significant period, and this period of being underneath this red line, the S&P has been following this little, now what appears to be a wedge-like pattern ascending. Now, before we get too excited about that, if you're a bear, I want to remind you that the reason that ascending wedges are bearish is because eventually investors lose the ability, let me change that. Eventually bullish investors lose the ability to make a trade that makes sense. So as you start to get out and further out into this wedge, you start asking yourselves, do I really want to buy at let's say you're looking at this this spring. Do I really want to buy at 1420 in hopes that we get to 1420 in hopes that the best case scenario is we get up to 1550. Well, that still has 10% in it, doesn't it? So that's not that bad a deal. So the reason I say that is typically a wedge creates a squeezing to the degree to where you only end up with a few percent of potential gain. And once that happens, buyers lose interest and selling just takes over. We're not there yet. And the reason I mention that is there is still some gains to be made, even as this gets a little closer and a little closer. Now, I got 4 arrows on this chart, and this is the first one, this is the second one, this is the third one, and this is the fourth one. And I will say this, in 2010, 2011, and 2012, if you were willing to get back in the markets at a point later down the road, the old adage, sell in May and go away, absolutely worked. This was May. This was also very near the 2000, very near the, well, it was the high until we made this inverted head and shoulders pattern and then came back very late in the year to surpass it. But that would have been a nice time to sell if you were willing to buy back on the dip. Look at this one. Again, that sell in May signal was at the very top of this head and shoulders pattern. This sell in May signal was on the right shoulder of a head and shoulders pattern. And, well, this isn't a signal yet, but that would be where it would line up. So, wouldn't it be a hoot, if you will, if the market came on up and tagged this red line in May? I think if you're long, you'd have to look at the handwriting on the wall and say, do we do this for the 4th time in a row? Is that really going to work again? Hopefully we get some indication other than just hitting this arrow. Probably we will. Now, what happened today? Well, today was essentially more sideways action. Clearly, we've got some resistance at right around 1518, and my feeling is that we may be forming a very small little consolidation here. If this consolidation does what it should do, then it would at least propel, if it breaks out to the upside, it would at least propel us up to this brown line in the low 1520s. Now this little diamond pattern, again, if I'm right on calling this a diamond pattern, it could be something else, guys, is what I'm saying. We could go down the road a little bit and look back on this and say, oh, that wasn't a diamond. We're actually making a head and shoulders top. It just has a funny looking left shoulder. I can't be too certain about this, but that's what it looks like for right now. And it now has a target of about 1530. So this consolidation, if indeed it is, could serve as a little bull flag that would then take us up to 1530. But I got this brown line here that it's going to have to overcome, and that would, that would. I think this line should give it a pretty good fight, because again, looking back, it extends back quite a ways, but we do know from the past that it can be violated, and it has been violated. So it could be that we see another violation of this line as we make that trek up into the mid-1500s, And if that's the case, then we could likewise see on a return to this bottom line another violation of it. Now what's interesting is if we do violate this red line on the next selling leg, whenever that occurs, by necessity, we will also have to have taken out this very long-term support line that is drawn over the initial panic bottom of 2009, that panic low October 3rd of 2011, and came very close to getting hit, not quite, just mid-November of 2012. So if we are going to make it up to this and over this brown line, then we should be coming down to check this red line, but in so doing would break this long-term support line, because you can see that long-term support line is over this current shorter-term current support line. Does that make sense? In other words, we got this line that has been working, and if we come down for another test of this, then it means we will have to take out this much longer term, call it a panic bottom line, that has really held the markets up when the selling has gotten heated. So guys, for right now, let's watch this little resistance line here. If that gets taken out, then I think we definitely tag this brown line right here. And again, if this diamond pattern is the right call, then we got a target of 1530. I'm just having a little bit of a hard time seeing the market get over this brown line, but if it does, then 1530. And that's just based upon the height of this consolidation pattern that we've been looking at for the past couple of weeks. I want to thank you for taking time out of your day to watch the video, and I appreciate each and every one of you who support what I do here, and I hope you continue, even though this is going to maybe get a little dicey. I hope you continue to stay tuned, and I hope you continue to derive value in looking at these charts using these old time-honored techniques. Take care.